Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. With me today is the head of investment banking at KBW, Joe Barry. Joe, it's great to have you back on the program with us today.
Great to be here. Thanks, Ed.
Joe, we had you on the series last year at the beginning of the year, and we talked about some of the themes that we were looking at for 2024. Interest rate environment was certainly a big one, and the M&A environment, the scrutiny and around M&A transactions, and the effort it took to get deals done. And we talked a little bit about the oversight by the regulators in the embedded finance area. And we started to lightly talk about AI and data and so forth. So I think a lot of those themes that we talked about probably played out the way we expected. But that doesn't mean those themes are necessarily the ones that we're looking at now. We're in a different world, obviously, the other side of the November results. So as we look forward, and as you look forward at 2025, are there some themes that you are seeing in the marketplace, whether that's around M&A or bank performance or consolidation? What are you seeing out there right now that folks in the market should be aware of and thinking about for 2025?
Sure. Well, the obvious one is that the regulatory backdrop is going to be more business friendly. Prior administration had a decided bent against mergers and acquisitions. And there's a belief, given what we saw in 2016, is that this one will not. And so it is a more vibrant market for M&A. We expect to see a higher level of bank consolidation across the spectrum. And there's a lot of pent-up demand for that to happen. I think the part that some people might miss is that we had a complete re-rating of several types of business models and cash flows. And essentially, any of the neobanks or FinTechs that were catering to consumers, whether it be on the lending side or money transmission or payments, there was a level of scrutiny that the CFPB was applying to those businesses that caused discounted valuations. And in particular, in July of 2024, when the CFPB came out with a comment that they were reviewing, kind of fee procedures around earned wage access, early wage access, and we saw a lot of the companies that were dealing with the consumer, really take a hit to their valuation, and those have completely re-rated higher. And in fact, in December of 2024, we announced a fairly prominent transaction where we represented Moneyline on their sale to Gen Digital. Most people don't know who Gen Digital is. It is the holding company that owns Norton Antivirus and LifeLock, right? And so it is a trusted source of protection for consumers, and they view that acquisition as a logical next step now to offer their 40 million direct users access to Moneyline's third-party enterprise network, where you could buy all types of financial products, right? So there is a general, it's been a general lift in the M&A markets, not only for the banks, which also re-rated higher, although there's some pressure on them now because there's a view that interest rates are not going to move down as quickly as everyone seems to think every year. But in general, it is a much more positive environment, and we do see volumes picking up markedly.
So I'm gonna pause on the tech side there, because I think there's quite a bit to unpack on that. But let me go back and start with the banks, because you made a comment early on there around pent up demand, and the fact that right. I'm sure, right, there's a historical trend, right, of a number of deals that are done each year, right? You've been doing this for a little while, and those deals were not getting done for the last 2, 3, 4 years, right? So how do you think about that pent-up demand concept?
Yeah. So in our last call, I think I had commented that 2023 was the worst year in bank M&A since 1992 in terms of number of transactions and a complete dearth of large transactions, really anything north of 50 million in deal value, which obviously isn't large, but it gives you some context on just how little activity there was. 2024 was better. It wasn't great. It was better. And we did see a return to strategic M&A. We advised in a number of marquee transactions, including South State Independent, and several other, sort of multi-billion-dollar transactions. Actually, I'll plug it. I think our market share is the highest it's ever been. It's since 2020. We've had 75% market share on any transactions over $1 billion in deal value in the bank space for the United States. And so I do believe that we have a unique perspective on sort of the volume and activity and what people are thinking. But to your comment, yes, there is pent-up demand, and we still have not seen a return to M&A from the category four banks and category banks, right? So anything over 100 billion in assets we have not seen deals happening there. We saw TD try to acquire First Horizon. That didn't happen, blocked. And we do expect that over the course of 2025, we are going to see the return of some of those buyers, whether they be Huntington, Fifth Third, Comerica, M&T. They're sort of coming through their process of preparing to cross over into the next category level from a regulatory perspective. We do expect to see them. But in the meantime, there is a lot of conversation going on in the mid-sized space. Call that banks between 10 billion and 50 billion as they, try to achieve efficiencies and higher profitability through scale.
So the banks that are preparing for those conversations, what have they been doing to get themselves in order, right? And what should people be thinking about as important themes to, you certainly you want to have your house in order so you can present that to the regulators, but also to the sellers, right? Because this is the landing spot for their banks. If someone is cashing out and walking away, that's one thing. But if someone's taking equity, they want that to they want to know that that's going in the right direction. So are there characteristics of these acquirers that are particularly important?
Yeah, I mean, so up until recently, and this still is the case, there were two sort of hurdles: 100 billion in assets and 250 billion in assets. That's when you cross over into higher categories of regulatory oversight. Anecdotally, we've heard from CFOs that the cost to prepare, both in people and technology, to successfully engage in that heightened regulatory oversight, it's about $100 million to $150 million, depending on where they were before at each level, and it's recurring. And so what we saw happening up until this most recent election is that banks were acquiring to get to somewhere between 65 and 75 billion in total assets, and they were holding there because they didn't want to go too close to the red line at 100 and have that huge cost burden them, because you could see ROEs come down on those companies as they had to spend. I think a lot of that fear has gone away. And there's two reasons for it. One is that there's just a realization that if you are 65, 75, or 80, you're going to be subject to that regulatory oversight anyway. So you're going to start preparing for it. So you're going to layer those costs in. And that there is not this significant sort of red line at 100 anymore. And that there will be the ability to sort of acquire earning assets to offset some of that cost. And so that is that pent-up demand, where there was a fear that if you were at 100 and trying to cross, it would be very hard to get regulatory approval. Same thing if you were 190 trying to get over 250. And I think that there is a view now that the regulatory environment is more conducive to, as long as you've proven out that you have built and tested that new oversight capability from a regulatory perspective, you will be allowed to acquire to get more earning assets to offset that cost.
One of the themes that we've been hearing in the market to that end is around data and the importance of data. Certainly, there's process, there's risk management, there's technology that underpins a lot of that investment. people getting their data in order is something that we're encountering more and more frequently, and I'm sure that that's part of those conversations that you're hearing there as well.
Yeah, and it is twofold. Part of it is just from a regulatory perspective, protecting it and understanding it, but the other part is to be able to compete with what I think the
Yeah.
biggest theme that we're going to see here in the next 3 years, which is the convergence of global brand platforms that own customer bases. So think names like Google and Amazon and Walmart, and even within the financial space, Klarna and Revolut. If you read what these companies call themselves, they don't call themselves banks. Clearly, the first three don't, but Klarna calls themselves an AI-driven payments and shopping assistant platform, right? They want to capture that moment where a consumer and a merchant transacts in the payment flow, and then
Yep.
being able to offer any financial product that the consumer and or the merchant needs, from a bank account to buy now, pay later, to installment loans, to credit card, to debit card. So why is that happening? Well, these big platforms have paid to acquire tens of millions or hundreds of millions of users. And
Yep.
why at the checkout and or at the bank branch would they not monetize that customer base further by offering financial product? But they don't want to be banks. They don't want to be chartered banks. Although if you listen to Klarna's CEO, they are a bank already. So is Revolut, and they're willing to buy a bank in the U.S. I don't believe the other businesses would. They don't want to run afoul of the bank holding company control rules. But a company like Walmart, I believe, is going to, and actually kind of does now through their one app platform, offer all the types of financial products that most banks can. And so
Yep.
the banks need to understand their data, because those big tech companies and retail companies that already own those customers are going to leverage that data to offer product in a way that is more innovative than banks do today, maybe outside of JP Morgan, right? But it is imperative that banks, the ones that want to survive, they claim those customers for themselves. And to do that, you have to understand the data and know where they're spending their money. There's one other thing that's really interesting out there, and that the Apple NFC being flipped open will now allow really any brand platform or bank or issuer to own their own digital wallet. And that is what Card is doing now, right? So they've got a network of called 100 million users on the consumer side and about 1 million merchants. And if you can see what they're buying and when they're buying it, and you can see how they're paying for it, what's the funding source? Is it Amex? Is it Visa? Are they pulling it from an unsecured line? And you start getting that data around the financial life of the consumer and or the small business, then you can offer them products that are yours and or third parties and do a rev share. And so I think we're entering a new phase of financial services, in that what the next generation considers their bank is going to be very different than what our parents did and what we do, right? Because they might consider Google to be their bank, or Amazon, or Rakuten for that matter. And so the data, understanding the data and understanding the customer becomes paramount. Long way of answering your question, but there's a lot going on right now. There's big things afoot.
Well, it's interesting because, right, we were talking earlier, and I'd like to get to this next, is the convergence of technology and traditional, right, charter holding financial institutions, and that's only one piece of the puzzle, right? This data concept, right? We were at a few events in the latter half of last year, and I think when we were together out at Nashville at the Gen FinTop Summit, I think one of the themes that I heard, and you were talking with we were talking with the CEO at dinner one evening about data is the currency of the future, and just data is, right, that is how one, you need it to survive, but two, you can really differentiate yourself and compete against someone who might be a bit of a laggard in that regard, and you'll run right past them.
Yeah, I mean, it is surprising to me still that a lot of the data that is housed within the industry, now most banks have to get extracts from their core, but they don't really do big data analytics on it to understand the profitability dynamics of the customer base. We recently sold a company called Strategy Core to a private equity firm called Estancia. Estancia is one of the owners of R&T, Roush & Tang, which is a deposit sweep business. And what Strategy Core did was basically analyze checking accounts, both consumer and business. And because they've got enough data from doing this for 25 years, they can tell a bank based on criteria which of their customers are profitable and not, and break it into cohorts by $50 increments of unprofitability or profitability. And
Yep.
just something as basic as that really is not at the fingertips of every US banking institution today. And so how do you know which customers to protect and or let go, or try to incentivize with better product and or free stuff, unless you know who they are first? Once you
Yeah.
know who they are, then you can take the next step to say, okay, here's what I want to offer them. And so I do think that we are going to see a big step forward now with technology providers to the industry, giving more tools to the banking industry to understand profitability and where dollars are spent. Because you're going to have to not only compete on efficiencies through cost, right? The user experience that technology providers and fintechs, neobanks, and these brand platforms like Klarna can provide are just a step ahead of what the banking, if not more, the banking industry. And we're going to have to embrace technology to create a user experience that makes people want to bank with that platform that is a traditional bank.
So let's pick up on that last theme there of embracing technology and how these institutions get to that point, because I think we've talked about in the past that historically, right, banks tried to build all this stuff themselves. They felt like that was in the last cycle was we're just gonna kind of hunker down. We're gonna take our capital and invest it in our teams. But the markets move too quickly, and right, folks that are doing that are getting left behind. So can you talk a little bit about the convergence you see there between, right, the banks that are successful and what they are doing on the M&A or the partnership space, and what that means then for, right, the fintech shops are, right, who are bringing this technology to the table?
Yeah, and let's bifurcate. Only the very, very largest banks were spending to develop their own because they have the dollars to do it. And like JP Morgan, for example, has a multi-billion-dollar tech spend. Obviously, their UX is great. Bank of America is the same. When you fall down below banks, let's say 200 billion, 150 billion, the differential in what they can spend is material from the top four.
Yeah.
And so at that point, those banks are relying on their core providers to provide APIs and technology to allow them to compete. And in that case, you're right. In 23 and the beginning part of 24, we did see a sense of, well, the market's been tough. Banking industry is under pressure. We, the core, are going to try to build our own technology we got this window to offer new product and services and UX to our banking clients. We're seeing a shift in that now, in that one, there's multiple private equity firms that own some of the modern cores like NCR Voyix, which is now Candescent, or CSI. And then the big guys recognizing that with consolidation on the upswing, banks will have a choice as to which core provider to use if they're not the same, which modern core or sort of API stack to put on top of it. And we're seeing the core is now looking to acquire technology to move faster. So acquiring some of these fintechs that are better at LOS or commercial account opening or consumer account opening or a digital banking platform, simply because it's just faster to come to market.
Right.
And if that fintech already has a reasonable size scale of customers, there's overlap, there's cross-sell, there's other things you can do. And we saw that firsthand when we represented DocFox in their deal with Encino. They were working together on a number of banks where Encino and DocFox were partnering together. And the Encino people realized, well, we can really increase our margins and cross-sell if we just own DocFox, right, which was a commercial account opening platform. And they knew each other, they worked well together, they had a commercial relationship. That's often how it starts. It starts with a commercial
Yeah.
relationships, a reseller agreements, and then the two sides realize, wow, this is really compatible. And I expect to see more of that in 2025 and into 2026, because it's going to be a race to see. There's only 130 banks over 10 billion in assets in the country, right? And now
Right.
there's a whole other business to providing technology to the very small banks and all the credit unions, because there's lots of them. But at
Yes.
that higher level, it's a race now to see who's going to have that market share in the larger banks.
Well, and I think that the other piece there you mentioned, right, there's the smaller financial institutions, and they need to do something in order to survive, right? Especially right when you go back to your earlier comments there that the community banks are not just competing against the other community bank, that's down the block. They're competing against the Walmarts and the Amazons and those right consumer brands that are becoming your financial provider, right? Not just your grocery delivery
Yep.
organization.
Yeah. No, you're absolutely right. I have found, interestingly, that the credit unions are actually embracing the technology faster than the small banks. I think there's just more of them, and it's based on the makeup of their customer base. They're decidedly consumer based. And we're
Yeah.
seeing there's a number of consortiums that have come together to help credit unions buy good technology. And
Yep.
there are providers that are really focused on it. And part of the reason is because there's so many more of them. And the consolidation trends in there, while they're still there, they're not quite as drastic as the ones that the tech providers, the larger banks. Because if one of your customers is a $50 billion bank, and you're providing technology to them, they get acquired by a $200 billion bank or a $300 billion bank, like chances are the larger acquirer is going to go with their tech stack. And that's a big swing for the tech provider. And so there is I clearly see a lot of the fintechs today. They've got if they're not already focused specifically on that smaller size, they've got their core product, and then they're doing a slimmed down version at a better price point to break into that smaller account base, whether it be banks or credit.
Yeah. Yeah, absolutely.
It creates granularity of your user base, all of that.
Yeah, we encountered a few of those situations. Before the holidays, folks came to us and said, "Look, we're not that size. We're this size. Can you give us something that gets us into the game? We know we need something, right?" And our view was, yes, look, we can create a focused offering, get ourselves in the door there, and give them a tool set that allows them to have a foundation for an enterprise risk management program, which we know they will need to grow into over time. So I think your point's well taken that there is a slice of the market that needs something that is not quite as big and complex and heavy and difficult to implement and maintain, but they need something to get going and get out of the gate.
Yeah, absolutely.
Joe, we've covered a lot of ground. I'm going to ask you one final question. You have an event coming up, I believe, for some of your constituents. So perhaps just give us a minute or two on that, so folks can be aware of that if that's somewhere that they should be.
Yeah. So that we host events across all of our financial services and fintech coverage across the year, but our next big event is our Winter Financial Services Conference in Boca Raton, which is February 12th to the 14th. It is sort of focused on larger cap banks, financial institutions, and fintechs. That is a decidedly investor-focused conference, so it's public companies and investors. We do have a fintech channel there as well. But I want to plug something that's really interesting. We will host our first Buyers and Builders Conference in April. In Napa Valley. We are partnering up with our venture banking group. We hired a large number of venture bankers from Silicon Valley after they merged with First Citizens. And so we're bringing together the venture investors, the earlier stage startups in the financial services technology space, later stage, and then the buyers of that. whether it be the cores, or the banks, or the other financial institutions, and fostering that ecosystem approach that we do at our FinTech conference and at other targeted conferences as well.
That's awesome, and certainly there's that's a hot space given what we were just talking about, right? And
Yep.
the fact that, right, those entities are going to be key to helping these financial institutions thrive, and those core system providers. And so it's cool to hear that you guys are leaning into that space.
Absolutely. Thank you
Awesome.
for having me. I really appreciate it. It's always a pleasure to be on with you guys.
Thanks, Joe. Appreciate the time and look forward to seeing you in the coming weeks.